Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the world's most famous coffee shop a good investment? In this video we will be analyzing if SBUX stock is a buy. Could SBUX, stock ticker symbol SBUX, be ready for a massive rebound? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on SBUX. SBUX was founded in 1971 by three friends in Seattle's historic Pike Place market. Back then, they focused on selling fresh roasted coffee beans and tea. 10 years later, Howard Schultz joined the company and was inspired by the coffee house culture in Milan, Italy. This led SBUX to transform from a coffee bean retailer to a coffee house experience. Their commitments to high-quality coffee and a welcoming atmosphere fueled their growth. They offer a variety of coffee drinks, hot and iced teas, along with pastries and snacks. Today, SBUX boasts over 35,000 locations in 80 countries, with their headquarters remaining in Seattle, Washington. Now let's look at the price action. Starting with the 1-year chart, we see that SBUX had a CAGR of about -23%. Zooming out to the 5-year chart, we see that SBUX had a CAGR of -2%. SBUX share price has been struggling as of late and has now returned to 2020 levels. This is either really good or really bad. A backtest comparison of investing $10,000 in SBUX versus the S&P 500 reveals significant underperformance for SBUX. After a set investment period, the starting balance of $10,000 in SBUX would have shrunk to $9,732, resulting in a negative 0.60% annualized return. In contrast, the S&P 500 would have grown the $10,000 to $18,133, reflecting a strong 14.14% CAGR. This underperformance is further highlighted by volatility. SBUX investment exhibits a much higher standard deviation of 27.50% compared to the S&P 500's 18.93%. Even the best year for SBUX, with a return of 24.17%, falls short of the S&P 500's best year at 28.75%. Similarly, SBUX' worst year decline of 17.82% is comparable to the S&P 500's decline of 18.17%. However, the maximum drawdown, which represents the peak to trough decline, is significantly worse for SBUX at -37.71% compared to the S&P 500's -23.93%. Finally, risk-adjusted return metrics paint a clear picture. Both the Sharpe ratio and Sortino ratio are considerably lower for SBUX at 0.03 and 0.05, respectively, compared to the S&P 500's 0.68 and 1.06. Overall, SBUX has underperformed the S&P 500 across nearly every metric. Now let's hop over to market share and take a look at SBUX's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that SBUX is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that SBUX has the largest market share and is still growing. This demonstrates just how strong the company's pricing power is. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for SBUX, SBUX, and see that the market share is 4.29% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that for every $1 spent on food, SBUX collects $0.0429. That is massive market share. The 5-year market share CAGR for SBUX is 5.15%. This means that SBUX's market share continues to grow despite its dominant market share, outpacing growth in the wider industry. If we start in 2020, we see that the market share was 3.64%, 3.87% in 2021, 3.89% in 2022, 4.27% in 2023, and 4.29% over the trailing 12 months. It is kind of amazing that such a large company continues to take market share. This is a great company. Let's take a look at the fundamentals to learn more. Gross margin is 28%. This is on par with other coffee shop businesses. Revenue has compounded at around 18% over the past 5 years and has reached over $36.5 billion most recently. Starbucks' revenue continues to grow despite reported headwinds and macroeconomic challenges. When we look at cash flow, we see a 49% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 17% CAGR. As a result, free cash flow has grown at a 174% CAGR. Starbucks has done a great job of growing free cash flow, though we should note that 2020 was a particularly tough year, so the 5-year comps probably look more favorable than they actually are. The good news is that operating cash flow continues to rise. Weighted average shares outstanding have fallen over the last 5 years, going from 1.18 billion shares in 2020 to 1.14 billion shares most recently. Starbucks has been very busy buying back shares. This is great. Starbucks is probably one of the best companies at buying back undervalued shares. Management is doing a great job. Now let's view return on invested capital. Return on invested capital has grown from 5.8% in 2020 to 15.4% most recently. This is a good trend and a decent value. I am optimistic that Starbucks can continue to improve return on invested capital. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 24 days in 2020 to 18 days most recently, Starbucks has gotten more efficient over time. However, 18 days is a very high value for such a successful restaurant brand. I would have expected a negative value and will look for Starbucks to improve this metric. Now, let's look at Starbucks' debt. The net debt to EBITDA has fallen over time, going from 6.7 in 2020 to 3.1 most recently. Starbucks has done a great job paying down debt over time. While 3.1 is a little higher than I would want to see, it is still a manageable level. Last, let's explore dividends. Current dividend yield is a healthy 2.97% with a dividend payout ratio of 61%. Starbucks is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 9.2% dividend per share CAGR over the past 5 years and a 16.3% dividend per share CAGR over the past 10 years. Starbucks' dividend history is very strong and I would expect this trend to continue. Starbucks looks to be a very fundamentally sound company. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Starbucks. It is a restaurant company with a gross margin of 28%. The 5-year revenue per share CAGR is 14% and the 5-year free cash flow per share CAGR is 177%. Whoa, good gross margin and great revenue and free cash flow growth is beautiful. Love to see it. A return on invested capital of 15% is okay but getting better. Next, the cash conversion cycle of 18 days is not very good. However, the trend is downwards, which means that the company is getting better at managing inventory as well as suppliers and customers. Concerning debt, a net debt to EBITDA of 3.1 means that it would take Starbucks a little over 3 years of earnings to pay back their debt. So from a fundamental standpoint, Starbucks does still look pretty good. Now let's switch our attention over to valuation. Starbucks is undervalued relative to the S&P 500 with a ratio of 0.7. The price to earnings growth, or PEG ratio, is 2.6, indicating that Starbucks is overvalued relative to their projected earnings growth. Starbucks is a great, historic company. They are by far the largest restaurant company and demonstrate strong pricing power and efficient throughput. Starbucks is doing all of the things I love to see: growing market share, free cash flow, and return on invested capital. With the share price down so much, investors often look for a reason. A post-earnings interview with the new CEO and Jim Cramer comes to mind. A Yahoo Finance article sums it up pretty well. Much of the discussion focused on whether Starbucks' premium coffee is overpriced, with Jim Cramer asking early in the interview if the coffee might be just too darn expensive. In response, the CEO admitted, "We have not been able to communicate to the occasional customer the value we provide," while stressing that its core customers still were seeing value. The really bad non-answer turned off many investors and was clearly a misstep by management. However, this sell-off might be a great opportunity for long-term investors. A Motley Fool article highlights this. Investors have clearly soured on Starbucks. The shares have taken a hit because there's uncertainty as to when things will start to improve. But this pessimism creates a buying opportunity for those who can look out over the next 3 to 5 years. Starbucks trades at a price-to-sales ratio of under 2.5 right now. Shares have basically never been cheaper in the past decade. While no one knows the future, Starbucks does look nice with strong fundamentals and trading at a relative discount. For me, Starbucks is going on the watch list. Many thanks for watching. What do you think about Starbucks and its growing market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.